Greetings from Hong Kong. My name is Julian Zegelman. I used to be a corporate and securities attorney for over a decade, and I've been involved in the blockchain space since 2014, which I think in blockchain years is forever. I'm currently a general partner at TMT Blockchain Fund. I recently made the transition into venture capital, and I'm now a partner with a $100 million venture capital fund that actively invests in some of the leading blockchain startups. The purpose for today's video is to discuss some of the questions I got recently about security tokens. I travel a lot, even though I'm based in Los Angeles in the United States, and oftentimes people ask me about security tokens. Do we invest in security tokens? Do I see a big wave building up? Isn't this the next big thing after ICOs and utility tokens? And I see a lot of misconceptions. I also see some promising areas, and I just wanted to take some time today and share some of my personal opinions and thoughts. Sometimes people use the term security tokens without really understanding what it means. And there are three general asset classes that are lumped together when people talk about security tokens. So it's important to understand what they are and how they're different and how each particular case is its own enormous industry with very different rules. Why do people lump it all together under some magical term security tokens? Well, this all began in 2017 when the Securities and Exchange Commission, as well as some other countries' regulators, said a very simple thing. They said, look, you're selling digital assets, cryptocurrencies, tokens that have characteristics of regulated instruments like shares of stock or bonds, security instruments, so you should follow the same rules as if you were selling securities. The industry, the blockchain industry, came about and said, wow, now everything is a security token. So what are security tokens? There are really three categories today. The first category is a broad digital asset that, per the applicable regulations, has to be marketed the same way as if it was a security. So this could be anything from a new type of cryptocurrency to what used to be called utility tokens or functional tokens that have a certain function. They're really pieces of software code or smart contracts that carry out certain functions, but now they have to be marketed and sold the same way as if they were shares of stock. So digital assets that per law now have to be marketed as securities, but are not representative of any security in the underlying company or protocol, that's one category. And if you think about the Telegram sale or the Filecoin sale, there were private placements of digital tokens that were done the same way as if they were selling securities, but the tokens you bought did not give you any equity in the company. But because of the new rules, the digital token itself that gives you certain functions, certain functionality once the protocol is launched, was considered a security token. So this is one category. Another category is what people often call digitized security or digital representations of actual securities, shares of stock in a company or corporate bonds or futures or other type of a security. So in the second category, what you typically have a smart contract which encompasses the same terms, rights, and preferences as you would have in a traditional security. So in the traditional finance world, when you buy a share of stock, let's say in a private company, you sign a stock purchase agreement and you get a share of stock, you get a stock certificate, the rights and preferences of that share of stock are written into the bylaws, you understand what you're buying. The idea is you take all of that, you package it into a smart contract that's represented by a digital token, and the token itself is a share of stock, right? The token doesn't give you any type of service or function, it simply acts as a digital representation of the underlying share of stock. That's the second category, right? Digitized securities. The third category is what's often called asset-backed tokens. Again, it's a smart contract, a digital token that is backed by an underlying asset. So instead of trading a building in Manhattan, you and I agree that we're going to create a token, and the token is worth the entire building, or the token is worth 100,000th part of the entire building. So it could be like a square foot in the Manhattan building, could be represented by a single token, and if I buy that token, I own, some fraction of the building. So we don't have to move the, we don't have to move the ownership in the underlying building directly, because that's cumbersome and expensive. We could trade the tokens that represent, a certain asset. The same is oftentimes experimented with commodities, where, for example, instead of trading the traditional futures on a ton of aluminum, we say that we're going to trade an aluminum token, and they're asset-backed tokens. About some challenges to mass adoption of security tokens today. The biggest and most important challenge is lack of liquidity. So liquidity means the ability to trade an asset, in this case a security token. Let's take a very simple example, tokens that represent equity in a company. The problem is that to trade security tokens representing equity, you need to have an exchange that is licensed to trade securities. Let's take the United States. In the United States, you have national exchanges like NASDAQ or New York Stock Exchange or American Stock Exchange, or you have what's called ATSs, Alternative Trading Systems, which is like the secondary level of exchanges that are allowed to do a lesser amount of things that a national exchange can do, but they can still legally quote securities and allow various players in the securities market to trade them. The one big problem today with liquidity, at least in the United States, which represents a big chunk of the global financial market, is there is nowhere to trade security tokens. Not a single exchange today is licensed to trade security tokens. I'm not talking about cryptocurrencies. For cryptocurrencies, there's somewhat different regulations, and companies like Coinbase, Poloniex, etc., they're able to trade Bitcoin, Ethereum, and other most liquid cryptocurrencies because both the CFTC, which regulates the commodities markets, and the SEC, the Securities and Exchange Commission, not in the most clear fashion possible, but did opine that the most liquid cryptocurrencies are not securities. When you talk about securities, for example, tokens in a fledgling startup company, there is nowhere to trade them. So if you look at the security token sales that happened, again, the most prominent ones are Telegram, Filecoin, there were also some lesser ones. There are lockups and there's general lack of liquidity, right? So you cannot just freely sell this to anybody on the open market. Typically, you can only sell it to other accredited investors. And typically, if you talk about the United States, there is at least a 12-month lockup period when the asset is illiquid. So in that sense, a security token is no different from just buying normal equity in a private company. What about public companies? Right? You would say that, okay, so we understand that with private companies, there's liquidity issues, and until there are crowdfunding platforms that get licensed to list tokens and trade them, or until one of the national exchanges starts to add tokens to its platform, there's not much liquidity. We understand that. But wouldn't it make sense for IBM or Google, instead of trading their shares the way it's done today, to put it all on the blockchain and start trading tokens? Well, the question is, what are they going to get out of it, right? So in my opinion, this is a process that's likely to happen in the next decade or so, but it's not going to happen tomorrow, and it's not going to happen until the underlying regulatory foundation and the ecosystem of the various players in the securities markets, like underwriters, market makers, custodians, brokers, wealth managers, is sufficiently experienced with digital assets, and the technology is mature enough where there's actual cost savings or advantages in execution speed of trades. So if you're a company that's publicly traded today and has the existing infrastructure today that works for you, why would you ever switch to the blockchain, right? Forget Google. Even if I'm $100 million market cap company, which is tiny by public company standards, and I have my shares trading on the OTC market, why would I experiment with blockchain? I'm only going to do it when the technology is mature enough and the infrastructure is ready, where I understand that I'm going to save 20% a year on compliance and trading costs by using blockchain solutions versus using the status quo. Or I'm going to do it if I understand that I'm able to save on transaction speed and I'm able to trade my shares quicker, and as a result my shares are more attractive to hedge funds and algorithmic traders and others. So until there could be actual cost savings, or until blockchain gives me better trade execution, I don't think we're there yet. Another misconception, I think, and hype about security tokens is that people believe that simply by creating theoretical liquidity or bridging capital with opportunity, you're going to create value, even if the underlying asset has no value. So here's a very simple example. Let's take real estate. There's a lot of hype about asset-backed tokens in the real estate industry. We all heard about people tokenizing condominiums in Manhattan. There are some projects to tokenize real estate in Southeast Asia. People are trying to tokenize everything, right? From vacation clubs to high-rises in Manhattan to buildings in Dubai to commercial real estate in Moscow. It is true that in the world of global real estate, sometimes you have very interesting arbitrage opportunities between areas where there is a lot of capital, but there is not enough real estate growth opportunity, and areas where real estate is doing extremely well, but there is little access to liquid capital. Very simple example. If you live in Jakarta, Indonesia, for example, where you're experiencing a huge boom in business and there is a lack of high quality commercial real estate, and so you know that by building high rise you're going to be able to lease it out for a lot more money on average than would you be able to lease a similar building in Cincinnati, Ohio. That's a great opportunity for somebody from Cincinnati to invest in real estate in Jakarta, in theory, right? And right now there's very little instruments available for the average Joe, for the average real estate investor from Cincinnati to assess, source, and close opportunities in Jakarta, Indonesia. So the proponents of asset-backed tokens drawing this, perfect, beautiful picture where you take a building in Indonesia, you tokenize it, and then you sell the tokens via some mysterious exchange to investors in Cincinnati. There are two big fundamental problems with it. First of all, you need to have an exchange that's licensed and compliant in every single jurisdiction where it operates, so that that sale is not illegal. And second of all, there needs to be questions of due diligence and quality and performance of the underlying asset. In other words, if you take worthless, illiquid assets that are worthless and illiquid, by simply packaging them in a different form, for example, as a digital token, and even selling them to the public, you're not going to create value. The assets itself is going to underperform, and people are going to lose money, and it's going to backlash at the industry. Think about the collateralized mortgage obligations fiasco of late 2008, 2009, when you took a bunch of mortgages on assets that were not performing, and then you repackaged them into highly synthetic, esoteric instruments that very few people understood. You created a global world crisis, right? An economic crisis. Very similarly, if you have an asset that nobody needs, if you package it into a token, it's not going to become better. It's actually probably going to become worse because it's got a chance of getting money into that asset and that money being wiped out.